Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about dividend increases at large banks, bear market lessons, and 58% of Americans living paycheck to paycheck. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. 3 of the 5 largest banks increased their dividend on Monday. Are they not worried about a recession?
Hey, good morning, everyone. Good morning, Allison. Thank you for that intro. I do have to say that with all of the gloom and doom out there, that the banks increasing their dividends is kind of surprising, right? And especially, and here's the article from CNBC, especially when you have, Jamie Dimon, arguably the titan of all of the bank CEOs, who's been in the chair, prior to the global recession in 2007, 2009, global financial crisis, I should say, more accurately. Talking about an economic hurricane, right? So obviously, JP Morgan and Citigroup are standing pat. The other ones are increasing. Again, that's Morgan Stanley, Goldman Sachs, and the fifth one, which named blank right now, Wells Fargo. That's what it was, or Bank of America, one of the two. But really, so when you think about, okay, a recession is coming or recession is here, all this negativity, why in the world would banks be increasing their dividend payouts? Well, when you look at the overall valuation of the bank sector, it's pretty undervalued. There's an article out there that says that Citigroup actually is worth about 50% of book value. And when you talk about valuations and book value means if you took all of the assets on the balance sheet, sold them just for cash, you would have basically twice as much as the what would be what the stock is worth today. So it's kind of crazy how cheap they are from a valuation perspective. I like JP Morgan as best of breed, but certainly that's the highest valuation out there is in JP Morgan because people believe in Jamie Dimon. The rest of the banks lag that significantly. I think Citigroup is probably the most undervalued, actually. So, but also that does tell me that, rising interest rate environment, the net interest margin that banks, charge, which again, that's the difference between the loans they make and the interest they pay. You may notice that, loan rates like mortgages, those sorts of things travel up fairly quickly, but I don't know that anybody's getting stuff in the mail saying, great news, your savings account's now paying 3% because inflation's higher. No, it's a competitive market, right? So if nobody starts paying more, then the rest of the banks don't have to pay more either. So obviously, if what they're paying out doesn't move or just barely creeps up, while what they're making goes up significantly, that difference net interest margin goes up significantly. So I'm going to take a little harder look at the banking industry here as far as investing. Again, I don't think there's any hurry because we're in this bathtub. I don't think the market's going to screaming back higher to new highs anytime soon, but certainly I think picking up some bank stocks on the cheap here is something I need to take a little harder look at.
Next, as the bear market continues, what lessons learned from previous bear markets are useful in dealing with today's bear market?
Well, it's good to keep everything in perspective, and that's why we bring out the charts. I'm not going to show any charts today because I show a chart almost every day. But we were down past 20%. Arguably, we bounced back above that. Yesterday sold off a little bit, but this comment, don't get sucked back in, meaning don't expect the markets to go screaming back to new highs anytime soon. They will over time. 100% in the history of mankind, they have. So I'm not worried about that. And I do think it's a good time to put money to work down here at these prices, but don't get sucked back into thinking that, it's going to end anytime soon. This article talks about, this rally we'll have rallies within bear markets. And, for folks that say, I want to go to cash and then come back later. If you look at the largest up moves of all time, which just doesn't have a chart to go with it, but all of the biggest, here it is, all the biggest up days are in bear markets, right? So think about that for a second. That's why when you have these 4% or 3.5% moves like we did, I believe the Friday from not too long ago, a couple of days ago. If you go to cash, you're going to miss these big up days. And then by the time you come back in, you will have missed, that kind of gain as things bounce off the bottom. So that's why it's far easier just to, early on reduce, get rid of all the speculative stuff. We've left a bunch of tech names. We've left a bunch, basically the entire crypto industry. We're out of that stuff now. We'll look for a re-entry later, but you really whittle down to just best of breed. And then largely you hold that through instead of trying to get tricky at the bottom. You don't really know what's priced in, what isn't, when good news is good news and when good news is bad news, and vice versa in financial markets. So it's just easier to kind of hold through so you don't miss out on the big move higher. So overall, the lessons they'll talk about in this article is be patient, stay invested, don't give up on your financial objectives and dreams just because of the stock market fluctuation. And what I like to say to folks is treat it like Zillow. I mean, if you're a homeowner, which most of my clients are, due to the fact that most clients are at the point where they own a home in addition to investment portfolios, think of it like your house. If you're in a, say, $600,000 house and it drops 100,000, are you moving? Are you going to sell that stupid thing because it's down? The price is down? No, you're not. You're going to keep it. If anything, you would be less inclined to sell it, right? Because you don't want to take those losses. Treat your portfolio the same way. It's literally exactly the same thing. It's an investment asset that is currently being priced lower than it probably should. And that's when you would be a net buyer, not a net seller, right? So those are the biggest lessons to be learned from bear markets of the past.
Last, an article came out this morning saying that due to inflation, 58% of all Americans are living paycheck to paycheck. Is that a doomsday scenario if recession actually hits the U.S.?
Okay, so I think this is a great article. I think there's some problems with it, which, I'll talk to those second. But first of all is every single listener out there, and I know my following is not in the tunes of thousands or millions, but if you're listening to this, thank you for listening, and take a look at your own financial situation, your personal economy, and personal being generally household, right? Everybody in it is kind of on one balance sheet, one P&L, if you will, from a financial statement perspective. But look at your own situation. Okay. And think about, okay, what if one or both people, the people that are working, what if they lose their jobs? How would that affect them? If inflation continues raging, and that's what's kind of causing the issue. Well, I think it's a uniquely American issue anyway, but it's being exacerbated, if I can attempt a big word like that, by inflation, right? So more, if you were close to the cut line of what's coming in and going out, just take a look about what would happen to your situation if we do go into, the mother of all recessions. You see the banner there, Kathy Wood. She's taken a lot of heat lately, of course. He says we're already there. I kind of think we're there too, but we won't be identified till later on. But, what if, talk through some what if scenarios, and that kind of tells you the strength of your balance sheet. So that's the positive side of this, is you can learn that, okay, Americans are stretching. They're stretching because we, as Americans as a whole, we like our stuff. We like our experiences. We like to live life to the fullest. That's not a bad thing. Okay. I often say money is a unique tool to enable the life that you want. Right. So if you want to make a lot of money to spend a lot of money, then do it. If you don't want to spend money, and then you don't have to make a lot of money, and you'll still be fine. It's whatever makes you happy. But when you look at the numbers here, and especially the staggering, 30% of those earning 250K or more living paycheck to paycheck, that can be kind of scary, because these things go into, there's some contagion, right? And we saw that in 2007 through 2009. We also have the crypto winter going on, where crypto is getting killed. And if people, crypto millionaires went out and bought, crypto mansions, guess what? They're going to come right back on the market, right? Once their cash flow, and they have to sell the asset, right? So learn from this, take a look at your own situation, protect yourself, realizing that when things start to spiral, people can get caught in it, and then things spiral more, right? Because they end up having to be forced sellers. So that's one side of it. Second side of it is, I'm really curious as to how they measure this. So, I look at I can only just talk to our own situation as a household. We live paycheck to paycheck. If your definition it is, we manage our expenses to what's coming in every month. So, a lot of people spend first and then income second. We both of us being pretty much on the same page financially, is we look at the money coming in. What does that enable us to do as far as, travel, family experiences, paying for, schools and sports, and then, doing nice things for ourselves. We kind of adjust that based off of how much we're making. Right. So if we make more, then we can inflate that higher. But as soon as if it would come back down, then we would just say, okay, well, a couple of vacations are off, we'll kind of dial it back. Right. So if you're using that definition, you could have a significant amount of net worth in assets. But if you, like me, are kind of a person that refuses to sell those assets, like we're not touching real estate, we're not touching our investment portfolios, we're not going to use any of that for cash flow, I guess by definition, I could say I fall under this category. So I think it's tough to say, what does that mean? Does it mean you're living paycheck to paycheck just because you don't like selling assets, right, that produce that passive cash flow, that whole get wealthy over time thing? Or is it they don't have any of that stuff and they're literally trying to get by paycheck to paycheck, which means they don't have assets to sell off if they had to? And I think that's what it means here. But I think it'd be interesting how many people would answer that question if they peeled it back a little bit more. But bottom line is, you see these kind of scary numbers, if you will, and, make some people that have made a lot of good decisions kind of chuckle. And obviously, if you're caught up in this, you're like, yeah, I feel you, right? Either way, it can affect all of us, though. If there's a recession or inflation continues, and when people start to hurt, that affects everybody. So just be aware that this is out there. Take a look at your own situation and make your own decisions accordingly. And the last thing, just as a shout out, as a prudent financial planner and frugal person by nature, is don't forget you also can adjust your spending rate. Right? A lot of times you can't make more money instantly, but you can spend less. So that's kind of the lever you have control over.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.